Hi everyone, Somi here from InPeak with another episode of Investor of the Day. Every Monday to Friday, we bring you an angel investor, a family office, or a VC who shares their investment thesis so that you know what they're looking for. Today, we are featuring Zamir Shukho from Vibranium VC. They are a pre-seed and seed investor from California who primarily invest in edtech, fintech, and information technology.
We invest in early stage SaaS companies with headquarters in United States that achieved at least $500,000 in annual recurrent revenue and that are growing around 3x every year. So the common trait we look for in founders is we want them to have the domain expertise in whatever the product they're building. But most importantly, we are eager to see them have that ability to hire the best people and the best talent out there, sell to the best companies their product or services, and raise money from the best funds. One of the biggest deal breakers for me is no transparency or misinformation. When founders are faking it too much, and then when we do a due diligence, ask them for some proof of whatever they were mentioning about their revenues, the growth, their achievements, we see no proof of that in real life, and that's a deal breaker. The advice I would give, definitely never lie to your investors. It's a very bad situation if you start a long-term relationship with fake information or a lie. So try to be transparent, because transparency builds trust. And investors want to trust founders. They want to support them and help them grow. But trust starts from being transparent and being honest about what's happening in the company at every moment of the time. And try to look at investors as partners that you will remain with for 6 to 8, maybe to 10 years. So investigate who the investors are, ask them a lot of questions, make sure there is a fit between your values and the values of the investors that come into your cap table. And when you feel there is a fit, that's when you close the deal. It's important for us to understand that founders have a vision for the exit strategy, but we all know that when it comes to early stage, it's very hard to predict what's going to happen in 8 years or 10 years from now. So having a vision and understanding, this is where I'm leading the company, this is how big I'm going to grow it, is always good. But as it typically happens, we'll see when we get there. There's going to be many offers to acquire a good, fast-growing company. There might be ambition to grow it and take it to the public market. So I think in the beginning, it's just important to see the direction, but you wouldn't be able to see the exact point of when you exit. For me, pitch is only the first step. Usually we see these startups during the demo days or some competitions out there. And after we like somebody, we would invite them to fill out an application on our website. So they get into our system, and then our team starts evaluating this deal. It is important for founders to keep up, because we get bombarded with emails and requests every day. So if you are feeling that you should have been getting an answer last week, but nobody is replying to you from this particular fund, it's okay to follow up with an email, as long as you saw that there was initial interest in the beginning. But again, try not to do carpet emailing. Make sure that investors that you're trying to reach have the thesis that fits what you are building. So it's the right match from the beginning, and then you explore the relationship further.
I hope you enjoyed today's episode of Investor of the Day. Make sure to join us at inpeak.xyz, where we have daily live webinars, masterclasses, panels, and networking opportunities. We now also have a forum where you can hang out with other founders and investors and build your network.